Warren Buffett retires, but leaves us with one final warning. It's not his farewell that truly matters, it's what he leaves behind, and what could be coming next. His departure doesn't just signal the end of an era, it could mark the beginning of a major shift in how we think about investing, strategy, and risk. Today, I'll explain why Buffett stepped down, who's set to take the reins, and most importantly, the final lesson he's leaving us with. Plus, I'll share 5 practical takeaways you can start using right now to invest more wisely for the future. Warren Buffett, now 94, has announced he will step down as CEO of Berkshire Hathaway at the end of 2025. And this is far from ordinary news. We're talking about the man who transformed a struggling textile firm into a global powerhouse worth over $1.2 trillion. Buffett has consistently outperformed the market for more than 60 years, guided by a philosophy that's as straightforward as it is powerful. Invest in what you understand, keep your composure, and let compound interest work its magic. Luckily, his decision isn't down to any health issues. In fact, he's said to be in good health. But he wants to ensure a smooth and orderly transition, one with a clear direction and no sudden surprises. The markets reacted quickly. Berkshire shares dropped by 6% during the day, not due to panic, but because markets are unsettled by uncertainty. However, by the end of the trading day, much of those losses had already been recovered. Now, the big question on everyone's mind, who's next in line? The name has been in the frame for some time: Greg Abel. He's been vice chairman since 1999, overseeing Berkshire's non-insurance businesses, and has long served as Buffett's trusted right-hand man. Reserved yet highly effective, he tends to avoid the spotlight, but is held in high regard within the company. Buffett once described him as having judgment, energy, and passion for Berkshire. High praise from a man not known for handing out compliments lightly. That said, there's an important distinction to make. Buffett isn't disappearing altogether. He'll remain as chairman of the board, continuing to steer strategic decisions and, in his own words, help preserve Berkshire's unique culture. And coming from the man who's been the company's heartbeat for decades, that's far more than just a ceremonial role. But of course, to understand what might come after Buffett, we first need to look at how we got here. Although Warren Buffett was already a well-known figure in financial circles, the real turning point came in 1965, when he acquired a struggling textile company called Berkshire Hathaway. And he didn't buy it out of blind faith in its future. In fact, he only went ahead after the previous owner attempted to backtrack on the original offer with a lower price, a turning point that ultimately changed the course of his life. With a philosophy rooted in common sense, long-term thinking, and unwavering discipline, Buffett built Berkshire into a corporate giant, with stakes in nearly 200 companies, either directly or indirectly. From Apple and Coca-Cola to MasterCard, American Express, and Kraft Heinz, Berkshire's reach today is enormous. And then there are the shares. Berkshire's Class A stock remains the most expensive on any stock exchange, trading at over $775,000 apiece. But what's truly remarkable isn't the price tag, it's the return. Since 1965, the value of those shares has risen by an astonishing 5,500,000%. In other words, every single dollar invested back then would now be worth $55,000. Put in $100, you'd have around $5.5 million. That translates to a compound annual return of 19.9%, nearly double the 10.4% delivered by the S&P 500 over the same period. And Buffett's personal journey? Well, when he acquired Berkshire, his fortune stood at around $10 million. Today, it exceeds $168 billion. Even after donating more than half to charitable causes. Remarkably, 99% of that wealth was accumulated after the age of 50, challenging conventional ideas about the timing of success. Now that you know his story and just how extraordinary the results have been, here comes the most valuable part. What principles did Buffett follow to achieve it all? And more importantly, what final lesson did he leave us with before stepping back? Let's explore the 5 most powerful lessons every investor can take from Warren Buffett. Timeless insights that are more relevant than ever. Lesson 1. Know your circle of competence. Buffett was crystal clear on this. If you don't fully understand what a company does, don't invest in it. In his view, a business model should be so straightforward you could sketch it on the back of a napkin. That's precisely why, for years, he steered clear of technology firms, despite Apple now being his largest holding, and instead favoured companies offering simple, everyday products that people understand and use regularly. Take Coca-Cola, for example. People have been drinking it for generations. The brand is recognised across the globe and its profit margins are strong. Buffett's thinking was simple. If you understand how a business works, you're in a much better position to assess the risks. And that's a more reliable safeguard than any complex financial model. Lesson 2. Look for an economic moat. Buffett often compared a great business to a castle, and every good castle needs a moat. In investing terms, that moat is a durable competitive advantage, something that makes the business hard to challenge or replicate. This could be a world-class brand, ultra-low costs that keep competitors at bay, or a distribution network that's second to none. Apple, for instance, has a powerful moat. Its customers are so deeply embedded in its ecosystem that switching to another brand would be a hassle. McDonald's, meanwhile, thrives on its global scale and consistency. And American Express benefits from a loyal base of premium customers that only strengthens over time. According to Buffett, a strong moat isn't just about defense, it should also grow wider over the years. Third lesson, the margin of safety. This principle, which Buffett inherited from his mentor Benjamin Graham, is as simple as it is powerful. If you believe a company is worth £100, don't pay more than £70 or £80 for it. This margin isn't about peace of mind, it's about safeguarding yourself against your own mistakes. Even the best investors get it wrong sometimes. The safety cushion acts as your shield against uncertainty, bias, and the noise of the market. Buffett took this concept a step further, always seeking that hidden discount in high-quality companies that were temporarily out of favour. He bought shares in companies like the Washington Post and Geico, which later multiplied by 10, 20, or even 50 times. Fourth lesson, contrarian psychology. Be fearful when others are greedy, and greedy when others are fearful. This isn't just a famous quote, it's the cornerstone of Buffett's philosophy. During the 2008 financial crisis, when the world seemed to be falling apart, Buffett invested $5 billion into Goldman Sachs. In contrast, during the tech euphoria of 2021, he began unwinding his tech positions. For Buffett, the real risk isn't market volatility, it's paying too much for an asset. That's why, beyond financial analysis, Buffett is a master at managing emotions in investing. And in the long run, that emotional discipline often makes all the difference. Fifth lesson, the macro dashboard. Buffett never ignores the wider economic context. After all, businesses exist within an economy, and when the economy is overheated, caution is required. That's why he created his own indicator, the Buffett Indicator, which compares the total value of the stock market with GDP. According to Buffett, this ratio helps indicate whether the market is overvalued or not. If it's below 50%, the market is usually undervalued. Between 75 and 90% is considered reasonable, but if it's above 115%, the market might overheat. And in this regard, Buffett has given us one final lesson before stepping down from the chairmanship of Berkshire. According to his own indicator, the market is currently at 190%, far above its historical average. In other words, the market is at record highs. Buffett's response to this? To hold a record level of cash. Berkshire now has more than $334 billion in liquidity. Not because he's fearful of the market, but because he's waiting for the perfect opportunity to act when others panic. Warren Buffett may be retiring, but his approach to investing will continue to guide millions for decades to come. And although he's stepping down, his philosophy of prudence and long-term thinking lives on in the other great investors. And with this being said, we will leave it here for today. I hope you enjoyed this content. Make sure to like the video and subscribe to our channel for more videos in the future. And I will see you next time.